Hi, this is Steve Eisman of the Eisman Playbook. In addition to doing the weekly podcast that we've been doing, I've decided to do something for you guys and add a weekly wrap-up of the markets every Friday. So here we go. Soon after President Trump announced his tariffs, which he called Liberation Day, the S&P 500 reached a low of 4,876 on April 8th and was down 16% for the year. Nasdaq was down even more. But since April 8th, the market has had a massive rally. As of the end of today, the S&P 500 was down only around 3.5% for the year, and Nasdaq was down only 7% for the year. And the U.S. payroll gain of 177,000 in April was very, very solid. For the week, the S&P was up over 3.5%, and Nasdaq was up close to 3%. I have no idea if this is the start of a bull market or just a bear market rally. And frankly, I don't think anyone else knows either. What happens in the trade negotiations between President Trump and multiple countries will determine the answer to that question. And on Friday, there was some positive news out of China that China is assessing the possibility of trade talks with the U.S. So stay tuned. However, the major news of the week was not about trade. It was earnings, and it was an incredibly insane, busy week with some very interesting revelations. I'd say this was a very mixed bag of earnings, but overall, I think managements almost universally expressed concern that the longer this trade uncertainty lasts, the weaker the economy is going to get. So many companies reported that I can't mention them all, so I'm not even going to try. And I won't even focus on, for example, certain weak results like the forecasts out of Block or Roku, where both stocks got toasted because of those results. I believe the results for Block and Roku are probably fairly unique to them. I'm going to focus on the earnings results that I think provide insights into the overall economy, and I'm going to divide up the week in earnings into three groups. 1, consumer-facing, 2, industrials, and 3, tech. So first, consumer-facing. This was a very mixed bag. On the positive side, the two companies with the broadest exposure to the consumer, Visa and MasterCard, reported better than expected earnings per share and also resilient revenue growth. They both stated that the consumer continues to spend. But other consumer-facing companies were much less positive. Now let's go down the list. First, General Motors. The actual results for the quarter were slightly better than expected for both earnings and revenue, but the company withdrew guidance because of tariffs, and it also suspended its buyback, which was kind of shocking to most people. Next, Domino's Pizza. Operating income missed by 2.5%. And same-store sales growth was a negative 0.5% versus the estimate of flat. In its press release, the company said that it was worried that macro pressure would continue to weigh on the company's ability to achieve its comparable sales growth target for 2025. In other words, management is worried about the consumer. UPS, they reported $1.49 versus $1.43 last year, which was a slight beat, but the company refused to update guidance because of economic uncertainty, and kind of shockingly, it also announced that it was cutting 20,000 jobs. Bookings, the travel company. The results were fine, and the consumer continues to spend, so there it was okay. On the other hand, Hilton Hotels cut net income guidance by about 6% because of, you guessed it, economic uncertainty. Norwegian Cruise Lines. Company's results were not the news. It did maintain its bottom line guidance, but it warned that cruise demand, which has defied worrying travel trends until now, is finally beginning to weaken. Church & Dwight, a staple company that sells household products. One of the brands it owns, for example, that you all know is Arm & Hammer. It reported a down quarter of 91 cents per share versus 96 cents per share. And the U.S. division saw revenue decline by 3% organically as retailers reduced inventory and consumption slowed. McDonald's results were really underwhelming, and EPS was a miss Most importantly, same-store sales were down 3.6% in the United States. If it were not for Visa and MasterCard, I'd say the results for most consumer-facing companies were disappointing, with some worrying trends. I just hesitate to put too much into that because Visa and MasterCard results were still good. Now let's turn to industrials. If there is a recession, it has not shown up yet in the results of most industrial companies. Honeywell. Company reported good earnings per share results. It maintained its revenue guidance and slightly increased its EPS guidance. It expects to offset $500 million in tariff exposure, which in the scheme of Honeywell is not that much, with price changes and other actions. Vulcan Materials produces construction aggregates. That's the stuff that makes roads and parking lots. It's a purely domestic company and reported a beat and strong overall results because of strong pricing. Caterpillar, which makes construction, mining, and other big machinery, they are an international company, but so far results were still decent. The company sees a fairly modest impact on margins from tariffs and thinks it can overcome most of it through actions on its own. And they also had good order growth. Trane, an industrial company that makes central heaters, air conditioners, and other stuff. First quarter was a beat, 2Q guidance was in line, and the company maintained its 2025 guidance, and orders were very strong. Strength in the US offset weakness in Asia. Quanta, it's the largest provider of contracting services to utilities. It's a big beneficiary of the need for more electricity in the United States because of things like AI. If Quanta reported problems, I'd really be worried. But the company reported strong results across the board, including great backlog, and it raised guidance a little bit. Eaton, an industrial electrification company, they are a major beneficiary of the reshoring of the supply chain back to the United States. If this company was having problems, that would also be a really bad sign. But they aren't. Earnings per share at $2.72 beat by a penny. Orders were in line, and the company reaffirmed guidance for 2025. And finally, the last group, tech, which everybody sometimes cares about the most. I would say the news in tech was mostly positive with some exceptions. Here's an exception, Supermicro. This is a tech company that makes servers. They compete with Dell. It's a big beneficiary of the AI revolution, but it didn't report. It pre-announced results much, much lower than estimates. The company attributed the miss to customers delaying purchases, and this implies that economic uncertainty is even impacting capital expenditures in AI. On the other hand, Microsoft, very good quarter, stronger than expected sales and profit growth, and Cloud Unit posted 33% revenue growth, which was a beat. Meta, maybe the best of them all, no problems here. Revenue rose 16%, and EPS was up 35%. Meta even increased its capital expenditure spending estimates for 2025, so it's still spending money building AI. Qualcomm, it's a multinational semiconductor and telecom equipment company. Earnings beat by a little bit, but it gave a slightly disappointing outlook for the next quarter. Company's worried about the current environment, but it does not see any impact yet. I would say this one was slightly negative. Amazon, everybody knows Amazon. It is a consumer-facing company in its retail businesses, but a tech company in its cloud business. It reported a strong quarter, but it provided soft guidance for the second quarter for both revenue and earnings, and it cited, you guessed it, economic uncertainty for the softness in the guidance. Apple, results were fine. Tim Cook was adamant that there was no pull forward of Apple's sales in anticipation of higher pricing from tariffs, so that's good. Also, I would just point out, it sounds like Apple is moving its production from China to India as quickly as they possibly can. So to sum it up and to conclude, if the trade uncertainty does cause a recession, it is not here yet. There are some signs of weakness in several consumer-facing companies like General Motors reducing guidance and stopping its buyback program. But Visa and MasterCard tell you that the consumer is still pretty resilient. Industrial companies are still doing fine. And tech shows mostly strength, but with a few signs of worry in companies like Supermicro. So in all, I'd say the quarter was somewhat of a mixed bag, which is what you should expect given the uncertainty. But given the fear that was in the markets that we are on the precipice of a recession, I'd bet that many people were afraid that results would be much worse. And that is probably one of the major reasons why the market rallied this week. However, assuming that there is no trade resolution for several months, we should see more signs of economic weakness. On the other hand, if the trade situation gets resolved quickly, economic activity should pick up quickly. It's all pretty binary, which is why it's really hard to make any big investment decisions right now. That's the weekly wrap. See you next Friday. Also, we have a fascinating guest in our podcast that will drop Monday. He is an expert in logistics and deeply immersed in what is actually happening on the ground as to the current and future impact on the U.S. economy from the tariff situation. We'll see you next time on the Eisman Playbook Podcast. Thank you so much for tuning in. For video episodes of this podcast, head over to our YouTube channel. If you're listening on a podcast platform, make sure to follow the show so you never miss a new episode. And if you got something out of today's conversation, we'd love for you to leave us a 5-star review. It helps us reach more listeners just like you. For links to our website, social media, and to sign up for our newsletter, please check out the show notes of today's episode. On that note, I'm Steve Eisman. I'll see you on our next episode.